Hello and welcome to another Property Solvers podcast. Today I'm really pleased to have Atuksha Poonwassie, MD and co-founder of Simple Crowdfunding. How are you doing today, Atuksha?
I'm really good, Ruben. Thank you for the invite.
No, great stuff, and thanks for taking the time out to chat with us today. So thinking back, I think our paths crossed initially at one of Brendan Quinn's events back in maybe 2015-ish. And I believe at that point, Simple Crowdfunding was already pretty well established. But perhaps to start, you can give us a little bit of background into your own career and how you ended up getting involved in property crowdfunding.
Absolutely. So my background is actually in CRM and data analytics. So that's basically where I started. And I ran a CRM consulting business for 15 years prior to crowdfunding. My co-founder, Davin, who's also my husband, his background is in IT, and he worked with a number of different clients on a consulting basis as well, just providing data and tech support as well. And he worked on some pretty decent projects. Some were security cleared. So we both have quite a technical background, and we were both interested in property. So we invested in property, have been for quite some time. And it was actually at a property event where someone mentioned crowdfunding. And we thought, hold on a second, that sounds quite interesting. So this was back in 2013. And that was early that year. And by the end of that year, we had our authorization because crowdfunding, if you can, we wanted to operate in the property space. That was number one. Two, it's about building relationships and communities. So that ties in really well with the CRM piece. And it's all platform driven. So that brings in the tech element. So that was actually our sweet spot. And we found it by chance. And it's just grown ever since then.
Well, and you were one of the first to actually set up a platform. Is that right? In the property space, I remember thinking to myself that it was yourself and perhaps Crowd Property were two of the main kind of operators in the space. I know quite a few have emerged since then, and kind of gone away as well. So perhaps, yeah, you could maybe start by giving us a little bit of a brief overview of what crowdfunding is, for those that are uninitiated, and how it specifically operates within the property sector.
Absolutely. So, in a nutshell, crowdfunding is a form of finance, and it's about lots of people putting in small amounts of money into a business or a property project or an idea, right? So, from a property standpoint, you have property developers who have great projects out there who need funding. And sometimes it's not readily available through traditional channels. The project might be a little bit quirky, or it could require a little bit more funding based upon what the traditional finance stacks look like. There are a million reasons why you get property developers who will come to crowd. So what happens then is they bring a project to a platform like ours. And then we work with investors, or we push it out to investors and community members, and they fund it. So say for argument's sake, you have a project and the developer's looking for £500,000. It could be that the minimum investment that's set for entry into that project could be £1,000. And so you then have 500 people who would put in £1,000. That's not typically how it works, because you might have someone who puts in £1,000, but you could have someone who puts in £50,000 into the same project. And so it's lots of people who would then put in affordable amounts into investments through platform. So, and that's what crowdfunding is predominantly about.
Right. Okay. And so it's almost like a share in the property project, effectively. So, if you put in, to use your example, 50,000, you would get a return on that 50,000. Whereas if you put a lower amount, you would get a return on that. And is it only accessible for kind of established investors or investors that are experienced? I know there's this distinction between sophisticated investors and high net worth investors. Is there a difference in crowdfunding, or can anyone effectively get involved in these projects?
Yeah, that's the beauty of it. If you go through a regulated platform, anyone can take part as long as they meet a certain criteria, right? So investors, their onboarding process is literally they register on platform. They have a small quiz that they need to do, which is like a risk assessment. And then they categorize. So are they a high net worth? Are they a sophisticated investor? Or do they just fall into the everyday investor category? And then when you're setting up a bank account, you have to provide certain information, such as a proof of ID and that type of thing. So we have final AML checks to do. Now, it may sound like a lot, but actually someone can onboard and become an approved investor in a matter of sort of 10, 15 minutes. It's not a big process, but they do need to go through that process in order to be able to register with us. So that's if you invest as an individual. We also can take investors who are companies. So you can set up a company investment account. You can set up a trust. So say you have a SAS pension, you can set up an investment account for your SAS specifically.
Right.
And you, as an individual, you can also bolt on an ISA piece. So if you want to then invest through your ISA, you also have the option to do that. So there's lots of different options, and each of those processes for onboarding is slightly different, but the core information remains the same.
Interesting. So it's not just for sophisticated investors and higher net worth investors. But can you kind of give a little bit of a description of who would fall into what type of investor would fall into those categories? Like what makes you sophisticated? What makes you high net worth?
Yeah, so if you're a high net worth investor, for example, it's do you have a pot of cash available, for example? So do you have more than £250,000 accessible? That doesn't include your pension, your family home, that type of thing. So net assets. So that's for high net worths. That's an example. For sophisticated, have you worked in the equity space, for example? Have you worked in finance? Or have you done more than a certain number of investments in the past 12 months? So each of those categories, when you register on platform, there's a description that's presented for each of those different categories. And people just read through and then just click on the one that applies to them.
Right.
If you're restricted, it's because you're not a high net worth or a sophisticated investor. Everyone else falls into that category.
So you can so the deal, it will depend on your kind of what kind of deal you can get involved with will depend on whether you are a sophisticated investor or a high net worth investor or quote unquote a normal investor. So certain deals you might not be able to access because you're not credentialed in the right kind of way. That'd be an accurate thing to say? Or?
That is possible. Through our platform, though, everyone can get involved as long as they've been through the registration process and they're an approved investor.
Right.
They can invest along. Yeah, so people who fall into the sort of restricted or retail category can basically then invest alongside sophisticated investors and high net worths if they want to.
It's interesting. So it's a good way for people that are perhaps starting off in property to kind of dip their toe in the water and get a bit of knowledge about property and learn about how, deals are put together, how they kind of work during the process. I think they call it learn to earn. Is that right? Or something
Yeah.
like that? Yeah. So it's probably good in a way to kind of work alongside the more established developers that you have on your platform, alongside the the sophisticated and high working.
Absolutely. And we love this for so many reasons. So when we started out, we brought the Learn Whilst Investing piece in. And what that allows people to do. So some developers will basically say, as part of their project, as it progresses, they'll provide certain learning elements and those learning elements are available to everyone who's invested. So that can be webinars, it can be site visits, it will be regular updates, written updates, and that type of thing. And it's often at sort of key stages. So if you're if you're going through the planning process, for example, it could be providing access to certain planning documents, or if there are challenges, how the developer is sort of overcoming those. And it's working on live projects. So not only would you expect to, as an investor, would you expect to receive your capital, the returns, as long as everything goes to plan, but you're also learning on live projects from people who are actually doing those projects. So we do have some investors. So if you have property people who maybe do renovations and then sort of standard buy-to-lets, if they then want to move into the development space, you sometimes get those types of people who also invest in development projects because they're just learning that next stage of the process, if that makes sense.
Yeah, and
And
it's quite a big step between doing kind of buy to lets and even flips to go into development. So, working with other developers that, have got the experience is probably a good thing, right?
exactly that. And each project or each investment has a forum. People have the ability to ask questions and along the way. And again, the beauty of that is if you have investors who have been in this space a little bit longer, they'll ask different questions to someone who's new because ultimately you only ask the questions that you know.
Mm.
And so sometimes by being part of a community and infrastructure like this, it allows you to then tap into this huge hive of knowledge, which you might not otherwise have direct access to.
No, it makes sense. That's brilliant. And I think I remember when we first met all those years ago, there were a number of property crowdfunding platforms that seem to be cropping up that no longer exist. Why do you feel that happened, and what do you think that platforms like Simple Crowdfunding have done differently for you to be able to kind of continue operating?
It's a really difficult one. There are so many reasons why the market has changed, and it really has changed substantially. So back in the early days, sort of 2013, 14, 15, there was a view that, crowdfunding is a great potential tool, and everyone decided that they were going to, or there was a number of people who decided that they would set up platforms, but they're property companies. And to actually have a platform and to operate a platform is actually a lot of work. And so it can't be a sideline. It needs to be the focus. And I think there were a number that started off thinking, how hard can it be? And then found out that actually this is a lot of work. It is a huge commitment financially and from a time perspective, and it just wasn't feasible for them. So some people came and went that way. The regs also changed, and there were a number of platforms that were basically operating under what's called an AR status, an appointed representative status. So people would then use someone else's license to actually provide the services that they wanted. And
Just to
the reg,
interrupt there, was that an FCA regulation that you're talking?
yes,
Something stipulated by the FCA? Okay, right.
yeah.
Yeah.
So the FCA then did a review of all of this and realized that actually a number of companies that were providing these AR licenses weren't actually overseeing correctly what was being done.
Mm.
So there was a huge cull a few, and I know that there are a number of platforms who basically lost their authorization pretty much overnight.
Right.
So the market shrunk quite substantially, and it
Mm.
did sort of shake things up. Um, as to where we are today, so the last, I'd say probably 3 years in particular, the regulation has just it's changed so much.
Mm.
It's become even harder. And
Ah,
so, unless you are in it, for the long haul, it's a really difficult space to be. There's been press coverage, even in the last sort of couple of weeks, about the regulator, so the FCA, and what impact it's having on sort of regulated platforms from a crowd standpoint. And it is a really tough environment. And so then the likelihood of new platforms sort of coming to market at this point in time is not super attractive.
right. Right. And I guess you continually have to jump through hoops to kind of satisfy the FCA, right? As a crowdfunding platform.
You do. And actually, when some of these regulations change quite drastically, um, there's something that someone said to me, and it really did stick. And it was, if you imagine someone says every day or, frequently that they're going to come and burn your house down unless you tell them why not. That's what it sort of felt like when some of these changes were being put in place.
Wow. Yeah, not for the faint-hearted by the sounds of things then.
Oh, absolutely not.
Yeah, yeah. Okay. And in terms of simple crowdfunding, am I right in understanding you operate on a P2P or peer-to-peer basis and an equity basis as well? Do you operate on kind of both sides of that coin? Um,
Absolutely, we
yeah.
do. And
Okay.
so
Could you explain a little bit about what the differences are, and and why it's important to understand that?
absolutely. So, um, in a nutshell, if we start with the equity piece first, in a nutshell, people are buying shares in the company. So when we're talking about a property raise per se,
Mhm.
people will buy shares in the company that typically owns the asset, right?
Right.
So it's like if you imagine the sort of Dragon's Den environment where you invest a certain amount of money and you buy equity or shares into that company, you're just doing that in the SPV, that's typically set up for sort of property projects, and you buy shares in that. Now, the projected returns on those tend to be, on average, around 25% per annum. So the projected returns are quite high, but it's also tied to a higher level of risk per
Right.
se. Because what happens is in a property project, when you're looking at a property project, a very, very basic finance stack could be you have a senior lender, so they'll take the first charge. Then you might have a sort of medium layer. So you might have a mezz layer or a junior layer,
Mm.
and they might take a second charge. And in its simplest form, you then have equity investors who are sat at the bottom. So the first two need to be paid back before you would see anything. So if that project goes south and it doesn't, costs go up, you have COVID, you have a number of other things that are going on, and the project's not doing that well, you potentially could lose more of your money.
Right. So the equity piece is effectively a joint venture with the developer, more or
Yeah,
less.
it's the equivalent of that, yes.
Right. So in the same way as you described before, can as many people as say you had like 10 equity investors, could they all get involved with the developer as an equity partner? Would that be possible, or would that cause complications with the lender? Because I guess the lender's going to want to know more about the individual investors that are putting in, they're kind of putting skin in the game, right, in terms of their equity contribution. would the
Yeah,
lender kind of want to know a little bit more about who they are specifically, rather than just like a bunch of people that are getting together?
it's different
Right,
because the senior lenders will know that an equity portion's being crowd raised, okay?
right, okay,
And so that information is shared ahead of time. And what happens is the senior lender, more and more senior lenders, when we were talking about it in sort of 2013, 20, even 2016, there were a lot of lenders who didn't understand the crowd space, and a lot more do now. And so once we sort of say a portion of the equity is crowd raised, we'll obviously have a conversation with them, and it's very unlikely that they will want to see information about every single equity investor, because
right,
ultimately the platform is sending one amount of money. It's just made up, or it's been collected from a number of different investors. The only caveat to that is if there is one investor, so say the raise is 500,000 and one investor invests 250,000, then the senior lender may want to see or may want further details about that one investor. It will just boil down to what portion of the equity they own.
right. And I guess, as you said before, there's a priority in the stack. So as long as the lender has got the first charge, they're
Yeah.
probably going to be more worried about that. So if, a situation happens where the development goes pear-shaped, then they will get priority over the fire sale or whatever has to happen with that project. Okay, yeah. So sorry, I kind of interrupted there. You were talking about the difference between P2P and equity. So yeah, perhaps you can go into the P2P side of things.
Yeah, so the peer-to-peer lending piece of it is literally loans. And so a developer will come to us and say, I'm looking for a mezz layer or I'm looking for a first charge loan. And again, the process is exactly the same. We have loan agreements rather than sort of shareholder agreements, which we have on the equity side, right? So loan agreements are in place. And again, we're raising £500,000 on a loan basis. And then people will decide how much money they want to loan to this project. The security we would take on behalf of all the lenders in this case. So if there are 10 or 15 people who have provided loan finance to a project, you don't have those 10 or 15 people who have the security in their own names. We would take security on behalf of all of them. So there's only one person or one company taking that security. Loans are typically a fixed return on a fixed term basis. So if that property project takes longer to complete, then actually it's not for the investors to say, well, actually, it's fine, we'll just let it run. That loan becomes due and it needs to be renegotiated if it's going to be extended. So that onus in terms of the responsibility then falls with the developer, and they have to make sure that that loan is going to be repaid. Otherwise, we will call in the security on behalf of the lenders, as long as everything else is fine.
So probably I would hazard a guess to say that if you're starting out in property or starting out in and looking into crowdfunding, probably the P2P model is probably the best place for you, because you're probably going to be a bit more higher in the priority list if the development does go wrong for whatever reason. That'd be fair to say.
It really depends what someone is looking for. So
Right.
we
The
do
risk
have
appetite.
some investors, for example, who will put the majority of their investments through loans or through peer-to-peer lending.
Right.
But then they'll also put a small portion through equity, because overall then, as long as everything goes to plan, the overall return will be a little bit higher. Does that make sense?
Spreading the risk of it as well, I guess, right? Yeah.
Yeah, you're spreading your risk. You have exposure to different types of opportunities. and that also helps learning.
Yeah, for sure, for sure. And in terms of working with developers, do you have your own due diligence process before you take on a project? So, not only are you looking at the project, you also check, do background checks on the developer, see what their track record is like, and what projects they've done. And what do you go through as a platform before you accept a developer or a property project onto it?
There's quite a lot of work that happens in the background through our due diligence process.
Right.
So the reviews are typically, and we're talking about sort of typical property businesses here.
Mhm.
We will review the company, so the company doing the raise, the individuals behind the company, and then the project. So it's at three different levels. Now, from a company perspective, it's like we'll look at the shareholder agreement, the articles, company's house filings, there'll be security checks on the company and all of that stuff. At the individual level, the directors of the business and the people who can influence the business, we want to understand that all that information has been verified. So if someone has or provides us with a CV and says, we've done 5 different projects in the past, and they're all exactly the same as this, we will need to have that information verified, especially if it's going into the IM, the investment memorandum. Okay. And then on the project side, it's looking at the financials, the comparables, so including the comparables and the costs. It will be the timelines. Is it feasible? So if someone says they're building a number of houses, they're going to build 15 houses from scratch, and it's going to take 6 months, we would question that. So it's sensibility checks at each of those different levels to make sure that whatever's provided or whatever the plan is sort of makes sense. And also then looking at exits for the project and for investors. So what are the proposed exits? If it's going to be a refinance, what's the backup plan if refinance isn't possible at the levels that they want? If it's going to be sales, what's a backup plan if you can't sell all of those units?
Mm.
So all of these things will come into the review that we do before a project is even visible on platform.
Yeah, and I guess over the last few years, a lot of developers have gone through these pains, and especially with rising inflation, rising costs. I think a lot of developers have really struggled, and not only contractors as well. So you've seen kind of building costs go up from like 40-50% over the last few years, and it's really important to stress test these developments as well. And I think people who come onto your platform probably need to do that as well to check that things go wrong, which they often do. What kind of cover is available, and what the developer plans to do. Yeah, it's a tricky industry for sure. And so in terms of why a developer who's looking for finance would use crowdfunding, what's the difference between kind of approaching a crowdfunding platform like yours and accessing things like bridging or development finance? I mean, why would someone choose to go for crowdfunding as opposed to the other finance options?
There's a number of reasons why people will come through crowd. And this is based upon feedback we've received from people who've raised funds with us. Some people want to, they have fantastic products, but not very many people know who they are. And so it's a really good way to actually get your name and your brand out there.
Right.
So that's one reason that people will come to crowd. The second is you can tap into funding sources and pots of cash that you potentially can't do through sort of traditional senior finance or where you're not grouping funds together. So ISA is a really good example of that. the fact that people can invest through their ISA into sort of the peer-to-peer or the debt side of projects, and all the returns that they then receive are tax-free,
Right.
it's a huge incentive. And the amount of cash that's potentially sat in ISA pots, not doing very much at the moment, is crazy. And so to tap into different sources of finance is a good thing. And then we also have some developers who do have a community of people who love what they do. And those people want to make sure that the funds that they collect for their property businesses are compliant and that they're not breaching regulation. And
Mm-hmm.
so we have some people who say we're really keen to make sure that we stay on the right side of regulation. And so we just want you to manage the compliance piece for us.
Wow, interesting. And in terms of kind of investor relationships, how do you handle issues that emerge over, over the project timeline? Say there's challenges or delays, for example. How is that all handled? Is it down to the developer to kind of communicate with the investors and kind of keep them informed of what's going on and just be transparent? Is that usually how it's kind of dealt with?
It's always best to just explain what's happening, because I
Mm.
think the it's when it's a surprise, that's when it becomes a problem.
Yeah.
And so developers provide regular updates. So the developer will provide one update to us and we get that distributed to everyone. So whether you've got two people in that investment or 200, it really doesn't matter. So one update will come to us and then we'll sort of run through that. And then that gets pushed out to investors. Now, if there are challenges, if there is a delay or whatever else on the equity side in particular, because the equity investors are in it for as long as that project runs per se, it's providing updates. On the loan side, if there is a delay, so we had one project, for example, where the refinance took longer. So we then worked with the developer and with the investors, and the developer just agreed to pay an extra amount for the
All right.
additional time that the loan ran, because it didn't make sense to call in the security. It made sense for the developer to continue with their refinance and get that done. So it just really depends upon what project it is, what type of project it is. And whatever happens, it's working with the developer and the investors to make sure that everyone is on the same page. So
Yeah.
often, where there is a delay or, the returns are going to be less than expected, it might be the developer then runs a webinar for the investors so that investors have the opportunity to sort of ask questions as well.
Right.
And between the crowd, there might be different approaches that haven't been considered. And
Mm.
so then everyone just works together to try and get the best outcome for everybody.
Yeah, rather than just scrapping the project and everyone throwing in the towel, you might as well try and come to a solution where at
Yeah.
least you can, absorb any losses or deal with the situation as it needs to be dealt with, Which is
Yeah. And but you're absolutely right, Ruben. Property projects do have challenges. It's how you manage those challenges
mm.
when those things happen. That's the thing that's really important to manage.
Yeah, yeah. And in terms of turnaround, say for example, I was a seller, I discovered that my development site was being crowdfunding. Most sellers probably would be happy with that, I would imagine. But in terms of kind of turnaround for a project to get funded, and a project to get going, or maybe a piece of land to be sold, what kind of timeframes are we looking at, or does it depend on the site and the scope of the development, the project, and that kind of thing? I mean, if you have a kind of average timeline.
It really depends upon the project as a whole. Does it have planning elements that need to be managed? Is it ready to go? You know, have they done the groundworks that are required? Every project is very, very different. Um,
Sure.
yeah, every project is just too different to say. The projects that if you're looking at a build of say 10 houses, you're probably looking at a couple of years, maybe 18 months.
Yeah, and it's planning that
Um,
seems to be the biggest hold up at the moment, right, for people. Yeah.
yeah, because you also need to leave time outside of the actual development to
Mm,
sell those units.
for sure, for
And
sure.
so one of the things, you know, before probably even 5 years ago, you could list a property and it probably would have sold within 3 months.
Mm.
Now, a lot of developers are leaving 6 months for that sales window because things are just taking a bit longer.
Yeah, it depends on where the project is as well, right? There's some markets that are a bit
Exactly.
more buoyant than others at the moment, and I think yeah, things are starting to improve. We're noticing it ourselves, but it's still challenging for sure. And okay, and so from perhaps we could split this next question in two for listeners, but what kind of returns can investors expect these days from crowdfunding property projects, like from a peer-to-peer perspective and an equity perspective? You know, do you have kind of rough estimates of what kind of returns can be expected?
Yeah. Yeah, absolutely. So equity investments are on average just seeing returns of around 25% per annum.
Right.
On the peer-to-peer lending side, our first charge loans are averaging between 10 and 12%.
Well,
And our second charge loans are sort of between 12 and 18.
right. Okay. Obviously, the second
So
charge one's a little bit higher because there's a bit more risk there. Yeah.
absolutely. So it boils down to what security is in place, the size of the developer. There's a number of things. It basically goes through our credit policy, and then a number is determined based upon the information provided.
Okay, great stuff. And sort of drawing things to a close, maybe you could run through some of the most recent deals that you've got on the platform. Anything of interest to listeners?
Yeah, we've had some really unusual ones. So more recently, one of the largest ones we had was the build of 62 houses. So that was a pretty substantial one from the Acorn Property Group, which was a really nice project. We've had a modular build that's going through or that's being developed at the moment. We've had a fairly substantial planning gain raise that's also through is it's in planning at the moment, and that's progressing. We've also done a number of other deals. So one of the things that we try and do is have variety. So we've got sort of cash flow projects that are also being reviewed at the moment. So where people will just get a return on their money, there's not as much development to be done. It really is a cash flow model. So it just allows people to get a better return on their money than they might be getting at the moment. But then it allows the developer to have some cash back to then go and do another project. Does that make sense?
Yeah, yeah, that's interesting. So perhaps these would be kind of maybe smaller projects spread over a longer period of time, or build to let, that kind of thing, or
Yep.
right,
Um, we've also seen some sort of standard sort of title split and conversion projects.
right.
And we're currently reviewing a fairly substantial assisted living project as well. So that's probably going to be the next one that sort of comes to market.
Interesting. And how do you see the property crowdfunding industry evolving over the next 5 to 10 years? Do you feel things like AI will have an impact, for example?
Yeah, I think it will. That there's new technology sort of coming through all the time. So if you're looking at sort of blockchain, if you're looking at AI, they're likely to have an impact. Crypto as well. So all of these things we're sort of keeping an eye on and just allowing it to sort of stabilize a little bit more.
Yeah.
AI will be great in terms of sort of allowing the right message to get to the right people faster. And so I think there will be quite a big change there from a comm standpoint. As to the property crowdfunding marketplace, I think it's just it's establishing, it's stabilizing. There's fewer, I appreciate there are fewer players, but actually it's become so much more acceptable and normal than it was even sort of 5 years ago. And that's a great place. But I think we're still at the early stages of that journey. The opportunity is immense. And if people can get onto the property ladder and start learning about property through investment, whilst they're sort of saving up, trying to save up deposits or trying to do their own property projects, this is a really, really good way of everyone being able to be involved in the property space sooner.
Yeah, exactly. Well, there's always risk, but I think you're minimizing it by the fact that you're kind of spreading it out between a number of people, right? I think that's one of the main kind of pros of getting involved with property crowdfunding. Thanks a lot for your time, Atuksha. Perhaps you can give listeners an idea of where they can reach out to you, your website, all that good stuff.
Absolutely. So the best way to reach us is definitely go to our website, which is simplecrowdfunding.co.uk. And then through that, you can contact us, just contact by email at contact@simplecrowdfunding.co.uk. And we'll make sure that any messages that need to be directed to Davin or I will get to us for sure.
That's great. Well, I'll add all of that into the show notes. And yeah, thanks very much for your time. I know you're super busy, and yeah, really appreciate you taking the time out to have a chat with us.
Thanks for the conversation, Ruben.
Thanks a lot. Really enjoyed it. All the best.